Good afternoon, everyone, and welcome to another edition of Your Daily 5 presented by StockCharts TV. My name is Grayson Roze. I'm the Vice President of Operations here at StockCharts, as well as the author of Trading for Dummies and Tensile Trading. I am thrilled to be with you here today. It's been funny to get on this show. Rachel, our video producer, who I want to give a big shout out to. Thank you so much, Rachel, for having me. When she originally asked me to be on the show, she said, "Hey, we got this new show coming out next week. Do you want to be a part of it?" I said, "Sure. How's Friday work?" She said, "Sure. Friday, 2 months from now. That sounds great." So it's been funny to get on here, but I'm really looking forward to it. Been looking forward to this for a while. As the format goes, I've got 5 charts that I think you really need to be watching for the current market environment. I'm going to run through those 5 and show you what I'm watching, talk you through how I'm thinking about each of them. So let's get started. First up, I have a chart of 3 different market cap levels. So here we have the S&P 500, which is large cap stocks. We have the S&P 400, which is mid cap stocks. And we have the S&P 600, which is small cap stocks. Now, the key here is that this 2-year chart shows you the pretty substantial divergence we've had between large caps and small caps and mid caps over the last 2 years. In the last 2 years, we've really seen this be a large cap market and really a mega cap market. But you can see here in the blue line, the S&P 500 in positive territory for the last 2 years, now recovered back after the drop that we saw earlier this year. Mid caps and small caps, on the other hand, over the last 2 years are both still firmly in negative territory. So over the last 2 years, we've really seen this substantial divergence between large caps and small caps and mid caps. Large caps have been leading the market higher. Now, what I'm unable to do here, though, is zoom in on the last month and a half. If we zoomed in on the last month and a half, what we'd see is the start of a shift here. We'd see mid caps actually leading to the upside, outperforming the S&P 500. Now, that's an important rotation because it's a departure from where we've been for the last 2 years. And there's been tremendous growth, tremendous recovery in some of these mid-cap names in particular. So that's an interesting one to watch. I'm looking firmly at some of these mid-cap names that are coming out with strong earnings reports, especially in the tech space. Lots of good charts to watch there. Next up, we have a chart of the Vanguard Total Index. Now, I look at the Vanguard Total Index because, a lot of people look at the Dow, they look at the NASDAQ, they look at the S&P 500, of course. But the Vanguard Total Index is an interesting measure because it's very, very broad. Now, it's still market cap weighted, so it's still heavily dominated by large caps. But VTI is sort of a broad measure of everything in the total US stock market. Now, what we have up here at the top is the Vanguard Total Index, VTI, versus the Vanguard Total World Stock Market Index. So up here, you can see that VTI, which is US stocks, the total US stock market, has been significantly outperforming the rest of the world by almost 13% there in the top blue line. So unbelievable leadership by the US market relative to the rest of the world. Now, where we sit specifically in this sort of trend picture of VTI, what I have here annotated on the chart is the Fibonacci retracement. So what you can see is that we've bounced up back from the lows that we had in March. We've bounced back up to the 61.8% retracement level. Now we've come off of that and bounced back up to it again. And where we closed on Friday was again right sort of at that 61.8% retracement level. So key levels to watch. And now actually where we are today, we're sort of bouncing off that level again, drifting a little bit lower. So what's interesting here is that we have had a major recovery, but we are really finding some difficulty breaking through this very important 61.8% level. That's proving to be some solid resistance here for VTI, also for the S&P 500. And so I'm sort of picturing this range here between those 2 middle lines that you see. If we do bounce off this level again and drift a little bit lower, we're sort of ending up in this range-bound pattern going sideways in the market as opposed to continuing to make higher highs. Next up, we have the Breton Picture, which sort of complements that picture of where we are on the trend. So this is an interesting chart. What we have in the top panel is the New York Stock Exchange new highs minus new lows. So this is a measure of stocks making new highs minus stocks making new lows. Now, I've charted this with a 10-day moving average. So it's a bit slower moving version, but it gives you a picture of sort of how that new highs, new lows index is moving. Now, as you can see there, we've just finally started to tick back up into the positive territory. The purple chart is sort of starting to emerge there at the top right of the chart. That means that there are more stocks making new highs than new lows. When we're in negative territory, we're dominated by new lows, which is bearish. When we go into positive territory, we're dominated by new highs, which is a good thing. Now, the fact that we're sort of touching the positive territory again on this 10-day moving average of the NYSE, new highs, new lows, that is a positive sign for me. I do like to see that. But in the panels that we have down below, what we have in blue is the NYSE, what we have in green is the S&P 500, and what we have in purple is the NASDAQ. Now, the top panel for each of those groups is the percentage of stocks in that index above their 200-day moving average, and then the percentage above their 50-day moving average. So it's a little bit small there on the screen, so I did clip out the numbers that you can see. So within the NYSE, we have 18.6% of stocks above their 200-day moving average. Now, that's pretty low. We do have 71% of stocks above their 50-day moving average. Now, the key is that this is a pretty substantial gap. We have a lot of stocks that have recovered nicely, and they are getting back above their 50 days. You can see that we have in the NYSE 70%, in the S&P 500 75%, NASDAQ 76%. Those are good numbers that I'm happy to see. For the 200 days, however, we have not seen a robust recovery yet above the 200-day moving averages. A lot of stocks still trading below their 200-day moving averages, which is not the sort of strong bullish participation picture that I really want to see. So I want to see some of these levels start to get above 50% at a minimum on the percentage of stocks above their 200-day moving average. And that horizontal line that you can see in each of these panels, that is the 50 level. So you can sort of see how 50 has been an important measure, especially there for the NYSE. Look at the time that we've spent above 50 relative to the time that we've spent below 50. And we are still very, very far below that 50 level on the NYSE stocks above their 200-day moving average at 18%. That is still very, very low. Next up, I have the XLY versus the XLP. Now, what this is intended to measure is offensive versus defensive. How is the market leaning? How are investors leaning? Are they playing more in the offensive sides of the market, or are they playing more in the defensive sides of the market? So this ratio measures consumer discretionary, the consumer discretionary sector, versus the consumer staples sector. So it's a very basic measure of offense versus defense. Discretionary is more offensive, staples more defensive. So when this ratio is rising, what we see is a favoring of offensive sectors. We see the market saying, yeah, we want to play some offense here. We want to go higher on some offensive sectors, take a little bit more risk, those kinds of things. When this ratio is declining, we see the market favoring defensive sectors, which is not the bullish case that we want to see. Now, the long-term trend here, we have seen a deterioration of this sort of offensive taste. But we are seeing a nice recovery here in the last rally, the recent rally. Now, this is sort of starting to take out what is a long-term downtrend. So this rotation to offensive sectors favoring discretionary over staples is a positive sign. I do like to see that. I'm very excited to see this bit of rotation to offense. So this is a key ratio that I watch, looking at sort of, again, offense versus defense in the market. How are investors leaning? So I'm watching this ratio carefully. If this can continue to tick higher, that is going to be a positive sign for the market. Now, finally, we have a historic chart here of unemployment. There's been a lot written about this recently since the numbers came out last week. The key here is that this is not the driver of the market. This is not, case one for me. I'm not selling anything because of this, but it's something that I'm keeping in mind and something that I want you to be aware of. This has been an unbelievably historic, unprecedented shift from historically low unemployment. We started this whole pandemic down at about 3.5%, which was fantastically low unemployment in the US. We have risen to 14.7, and a lot of people saying it's actually higher than that if we take everything into account. But The rise from about 14.4 in the last report to 14.7 now has been completely unprecedented and just very, very historic, so rapid. And it is a good measure of sort of what's happening out there in the economy and the disconnect that we're seeing between sort of some business conditions and the market as a whole. So something to be aware of here. Again, it's not sort of a primary indicator, not a reason to sell, but definitely one to be aware of. This is a historic moment for unemployment in the U.S. So those are my daily fives. Now, I do want to let you know all of these charts are part of my weekly market evaluation list. That's sort of the first routine that I jump into every single Sunday. I've set that up as a shareable link. So after the show, I'm actually going to tweet out that link, give it to you. You can go get all of these charts, the full list. There's 20 charts in my market evaluation list. You can go see all of those, and you can also save them into your own StockCharts account. So if you're a member, definitely go follow me on Twitter, look for that link. You can click that and you'll get 20 market evaluation charts that I think are really great to have in your own account if you don't have them already. So definitely look for that. My name is Grayson Roze, at Grayson Roze on Twitter. You can go get that link after the show. So again, I want to thank you for having me, StockCharts TV team. This was a blast. And thank you for watching. Tune in again for the rest of the week. We got some fantastic presenters coming up on your Daily 5. So be sure to tune in. Don't miss those.
Hey guys, Grayson Roze here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.